Hi class, welcome to chapter 14 of the IFC class, the Investment Funds of Canada. Chapter 14 is Understanding Mutual Fund Performance. We're getting close to the end of the textbook. Again, like always, please read the chapters entirely, word for word, page by page. These are simply just a synopsis of the chapters for your assistance. All right, understanding mutual fund performance. The key focus of this chapter and this topic is determining if a fund manager's asset allocation adds value beyond comparable funds or passive market indexes. So, by understanding what the performance is of a mutual fund, we can start to understand the value that a fund manager might be adding or not adding to a mutual fund. Performance measurement. This involves the calculation of the return realized by a portfolio manager over a specific time interval called the evaluation period. In context, the evaluation requires comparing the fund's return to the returns of either similar funds and or an established market benchmark. And again, we talk a little bit about benchmarks. We'll go into it a little bit further as we move along this chapter. So the goal of performance evaluation. Performance evaluation is an important function for mutual fund reps to assess the overall suitability of the fund they have recommended. So total rate of return, the most frequent measure, compares the net asset value per share, we've called it NAV-PS before, at the beginning and the end period, usually assuming the reinvestment of all dividends. So it's the most simple of return calculations. Basically, what did the portfolio start at and what did the portfolio end at over a specified period of time gives us the rate of return. So one of the key calculations you'll have to do when we've talked about this rate of return calculation before, the gain of a portfolio would be the ending NAV minus the beginning NAV divided by, the beginning NAV times 100. That will give you the rate of return over whatever period you are looking at. And now, a key note is that if funds are withdrawn or added, this formula won't be accurate. So another key concept this chapter discusses is the risk-adjusted rate of return. So it's not merely enough simply to compare risk. If we are simply compare returns. If we are simply comparing returns from one to the next, we also are sometimes assuming an amount of risk in a portfolio. So looking at the rate of return is great. It is one piece of the puzzle, but not everything. We have to also factor, when looking at rate of return, we have to factor in risk. A couple ways of looking at it. The Sharpe ratio. It's a tool used to compare the excess return of the portfolio. So in other words, the return of the portfolio minus the risk-free rate of return to the portfolio standard deviation. So how do we interpret or we use a Sharpe ratio for? It measures the portfolio's risk-adjusted rate of return using a standard deviation as the measure of risk. So again, what that would mean in its simplest form is that the Sharpe ratio simply takes away or subtracts the risk-free rate of return, so the return that someone could get by simply investing in an investment that has zero to no to very little risk. A lot of the times we'll talk about the T-bill rate of return being the risk-free rate of return. So the Sharpe ratio formula you should be memorizing for the exam. So the Sharpe ratio equals the RP minus the RF over the OP. And the RP is the rate of return of the portfolio. The RF is the risk-free rate of return. Again, typically the average of the 3-month Treasury bill rate. And the OP is the standard deviation of the portfolio. So if you have those three key numbers in a question, the risk-free rate of return, the return of the portfolio, and the standard deviation, you can use this formula to calculate what the Sharpe ratio would be. And that could easily be a question on the final exam. So benchmarks for assessment. Performance assessment is based on comparing a mutual fund manager's results to two kinds of benchmarks. The first being benchmark indexes, which we've talked about before. An index simply reflects the mutual fund's investment universe and can be used as a standard against which performance is measured. The benchmark chosen must be relevant. So you might compare a BMO Canadian equity fund against the TSX Canadian equity index. So again, the index being simply the overall Canadian market, we might compare a Canadian mutual fund, stock mutual fund, to the overall market. And what we mean by you wouldn't want to compare an equity fund to a bond index. We would compare an equity fund or a stock fund to some type of stock index. We would compare bond mutual funds to bond indexes. The other benchmark is the comparison universe. So the performance of a peer group of funds that have comparable asset classes and risk profiles. So you might compare the BMO Canadian equity fund to a broad measure of different Canadian equity mutual funds. So again, the first one, you're comparing it to the overall market. The second one, you'd be comparing it to its peers. So key Canadian mutual fund benchmarks that you would want to know. The S&P TSX composite is what we discussed or described as the benchmark for the Canadian equity funds you would compare. The S&P 500 is an index or a benchmark you could compare U.S. equity mutual funds to. FTSE Canada Universe Bond Index, we would compare Canadian bond mutual funds to. And the FTSE Canada 91-day T-bill index, we would compare money market funds or cash components to. So the comparison universe and quartiles. So the comparison universe compares a mutual fund's returns with the performance of a peer group, comparing like mutual funds to each other, and then which is made up of mutual funds with similar investment mandates. From that, we can get quartile rankings. So a quartile sorts performance into 4 equal parts or blocks. So if we are looking at all of the Canadian equity mutual funds, when we're using comparisons, we might be able to use a quartile ranking by the outcomes of those comparisons. If a mutual fund is performing very well, it would be ranked within the first quartile, the top 25% of funds with the highest returns. Second quartile would be the next 25%, so on and so forth. So obviously the first quartile ranking would be the best, fourth quartile ranking would be the worst. So again, interpreting quartile results, a fund manager would aim for stable and consistent performance in the top 2 quartiles. Shorter term rankings like 1-year returns are more volatile and should not be given too much importance. In assessing fund suitability for a client, consistent performance should rank higher in choice than volatile performers. Again, it's not simply looking at what is currently top quartile. It's looking at top quartile rankings over different periods, maybe looking at the last 1 year, 3 years, 5 years, and 10 years. The higher the quartile ranking for a longer period of time, typically the more consistent and the better long-term investment strategy those mutual funds would be. The complications in fund performance, the portfolio issue. So there are several issues that complicate accurate performance comparisons. The first is dissimilar portfolios. So comparison between 2 funds with different objectives, a fixed income fund versus a growth equity fund, that's often misleading. Even funds within the same category, 2 different styles of equity or stock mutual funds would perform very differently. For example, a Canadian dividend equity fund versus a Canadian growth equity fund. The dividend fund would seem much more stable and income oriented with growth. The growth fund would have zero income, may have several years of stagnant growth, but then have 1 or 2 years of incredible growth. So again, comparing dissimilar portfolios can be a very large issue. Actual asset composition. So fund classifications may not accurately reflect the actual asset base of the fund. A fund classified as a Canadian equity fund may at times hold significant portions of their assets invested in equities, their assets invested in other equities and other than Canadian stocks. Again, so 2 Canadian equity or 2 Canadian stock mutual funds, one might have a very large position of cash for whatever reason it feels versus the other. And again, like my last example, one might be focused on dividend equity investing versus growth equity investing. So the same title or classification of a fund does not mean it's a similar fund, and the performance would be very different from each other. Portfolio construction is the third issue. An investor targeting a specific sector, like for example, gold stocks, may be surprised if a specialty fund holding a large percentage of its assets in cash, reducing the intended exposure. Like I just discussed, different portfolio construction and different portfolio managers' theories of how to make up a portfolio might mean there's a very different look between 2 funds that on the surface look very similar. So complications in fund performance regarding risk and volatility. So comparing funds without adjusting for risk can lead to inaccurate conclusions. So relative risk, one equity fund may be conservatively managed while another might invest in much riskier stocks, even though they would be in the same category. Just because 2 funds are listed as Canadian equity mutual funds, one might be a large cap portfolio built of very large, very stable Canadian companies. The other might be a small cap Canadian equity fund looking for growth and huge opportunities, but sacrificing short-term gains. So different volatility measures in regards to comparing mutual funds. Standard deviation. This measures how volatile the returns have been over a past period. A higher standard deviation indicates a riskier or more unpredictable return. Beta. Beta measures the extent to which a fund is more or less volatile than the underlying market index. So if we are looking at a Canadian equity mutual fund, we would compare that to the TSX Composite Index, and beta would show us how much more or less volatile that Canadian equity mutual fund is than the broader Canadian stock market, the TSX Composite Index. Best and worst periods. Looking at different time periods can determine best case and worst case scenarios. One of my favorite pieces of information to discuss with clients when I'm looking at ETB's selection of mutual fund portfolios is we have the worst case, best case returns over a multiple number of different year scenarios. For example, a 1 year, a 3 year, a 5 year, and a 10 year best case, worst case of each mutual fund portfolio to show us that in the worst case scenario, the market declines the worst it ever has before. This is what this portfolio has declined. And on the flip side, this is the best this portfolio has ever done in any 1 year period over multitude of different years. It's a very good piece of information to give to clients. All of this simply is meant to teach you that there are many different aspects to simply comparing funds and making recommendations. You have to use many of these tools, many of these definitions, many of these terms to describe, to educate, and to make recommendations. So the drawbacks of the comparison universe method. So the comparison universe method has pitfalls that can compromise its accuracy. So what's the definition of a universe? Universes that are too broadly or variably defined are not comparable. Matching risk profiles. Universes that do not match for risk are not representative. Universe size. So some universes that are too small, example through partitioning into sub-universes, are not reliable. And survivorship bias. Defunct or unsuccessful portfolios drop out and are excluded from rankings, resulting in a universe of survivors. This bias can make adequately performing managers appear to have underperformed as the investment period lengthens. That last bit, what they're talking about there is that sometimes some mutual fund companies will fold or close certain mutual funds that are underperforming in order to make other portfolios that they have or mutual funds that they own or have or operate look better as a family, as their whole company. So you've got to remember that there are some ways that comparing mutual funds can be slightly manipulated. So be comparing funds and fund universes with a grain of salt. There's always a reason for everything behind numbers. So a case study application. If we're going to contextualize negative returns, think about this example. A client's ABC Emerging Market Equity Fund posted a negative return over the last year, causing the client to worry about underperformance and look for alternatives. So with the initial assessment, you, the representative, must perform a performance assessment comparing the fund against its relative benchmarks and peer group. So if you're doing the research and what you have found, if you're comparing this ABC Emerging Markets Equity Fund to its peer group, it actually outperformed 90% of its peers. So then we look at the ABC Emerging Equity Fund and compare it to the benchmark, the MSCI Emerging Markets Index. It exceeds the benchmark return, so it exceeds the broad emerging markets index. It posted a smaller loss than the rest of the market on average. And then the long-term performance of the ABC Emerging Markets Equity Fund is better than average returns over 3, 5, and 10 years. Next, we look at beta of the ABC Emerging Markets Equity Fund. The result is 0.8 relative to the benchmark, so it's less volatile than the market index. And lastly, we look at the risk-adjusted performance. It's rated 5 stars, the highest rating you can get, showing superior performance for the level of risk taken. So our final conclusion from all of our research is that the fund did post a negative return, but this was less than the loss experienced by the entire market sector. The manager effectively reduced risk and achieved a superior risk-adjusted return. And the client, when you tell this to the client is reminded of the importance of maintaining a long-term perspective when considering a fund's performance. A negative return on any investment should always be expected at some point. No type of mutual fund is what we would say guaranteed. There's always risk to it. So, again, a summary of this evaluation chapter. Absolute return measures the actual gain or loss of a specific fund over a period using the change in NAV-PS. Risk-adjusted return measures the return achieved for the level of risk taken, and we use the Sharpe ratio for this. Relative to benchmark measures performance against a relative market index. We use any of the benchmark indexes. Relative to peers measures performance against other similarly managed funds. For that, we use the quartile ranking. That ends your chapter. I will be posting some links to any other YouTube videos I could find that are relative to this to give you a little bit more description of some of the key concepts. As always, read the entire chapter, and we'll see you next time.